muting yourselves, just click the record button. Hello and welcome everybody. My name is Anthony Price, and I just cannot wait to share with you three main strategies, three entire strategy categories to help any six-figure business owner to save $20,000 to $40,000 or more on their next tax return. So without any further ado, let's get right into it. Let me introduce myself first. My name is Anthony Price. I'm a finance and accounting graduate from the University of Nevada, Reno. I lived in Reno and got my public accounting experience in Carson City, Reno, Nevada. So a ton of our clients are from the Bay Area, Lake Tahoe area, right? The Southern California. The majority of my clients are California based. So let's see, if you guys don't mind muting, that would be amazing. Yes, UNR, let's go Wolfpack. So I'm a CPA specializing in tax planning. I figure that there's plenty of tax return mills out there, right? But there are very few accountants, especially young accountants with all this energy, that are not only preparing returns, but teaching people how to save on their tax bills. It's a little bit more valuable if I can not only prepare your return, but teach you how to save $10,000, $20,000, $100,000 on your next tax return. So I myself am an entrepreneur working with other entrepreneurs. So that's why I've targeted entrepreneurs. I want to teach you how to save taxes because these are the strategies I implement for myself. These are the strategies that I implement for all of my clients. I work almost exclusively with entrepreneurs. I'm absolutely not a tax return mill. You know, I've seen firms that have 100 clients or 1,000 clients that they're doing W-2s, 1099-Rs, 1099 SSAs. I work with entrepreneurs. I work with Schedule Cs. I work with partnerships. I work with S-Corps. I work with trusts and nonprofit organizations. I don't do high volume. I do maximum value with my specific target market. So that is about me. That is my firm. If you guys have any questions, feel free to drop them in the chat about any of this stuff about me or any of these strategies that we're about to talk about. So without further ado, let's get right into the first one. I'm going to mute everybody. Okay, just to keep it quiet. Y'all can still hear me, right? Didn't mute myself on accident. Let's get started. Perfect. So number one, we're going to jump right into the deep end and discuss charitable strategies. Okay, there is significant opportunity within charitable strategies because the IRS benefits any organization that helps them perform their benefits. So when you're providing housing, when you're stimulating the economy through your business, or when you're providing charitable benefit towards an altruistic positive purpose, they're going to give you significant tax benefits, right? And so what we help you do, or we teach you how to do, a good tax advisor can teach you how to both leverage tax benefits for yourself and your family and benefit the world in some charitable altruistic purpose. So we're going to talk about some high-level tax strategies here through private family foundations. I'm going to discuss a quick charitable LLC strategy. I'm going to jump through that one because it's actually really, really advanced. And we don't have time to get into all of that. That's for someone at the higher levels of income. We talk mostly about private family foundations because I think it gives you so much leverage for your personal finances while you're benefiting a charity and altruistic purpose as you see fit. So the strategy is doing well by doing good, right? You're doing well in life by doing good. So let's get right into the private family foundations. This is a really powerful strategy right here. I mean, there's a reason why the Gates Foundation is a thing and the Clinton Foundation is a thing. And, you know, the Buffett Foundation, the Bloomberg Foundation. I see all kinds of athletes and coaches that create their own foundations. And of course, it's because they do want to benefit the world with all the wealth they've generated. But you'd be naive to think they aren't enjoying the tax benefits that foundations and charitable entities offer as well. So let's discuss that quickly to see how it can benefit you while you're also benefiting these charitable purposes. I mean, we have clients that are out in, you know, third world countries, helping build wells, build schools, and do amazing things for the world. And they're net profitable based on the tax savings that they're also receiving and the other deductions, the other benefits that they're able to leverage for their personal wealth. You can do both. The only loser here might be the IRS, Uncle Sam, right? And I would argue that they don't even lose because their entire sole purpose is for the world to be better. And if your life is better, if that charitable entity is served, then everything's better. It's a win-win-win. So tax specifics. With a private family foundation, you can contribute and deduct up to 30% of your adjusted gross income. So let's say, for example, you make $500,000 a year. You can contribute and deduct up to $150,000 into this private family foundation. Now, let's say, because there's so many California individuals in the Zoom right now, let's say your marginal tax rate, because you're making literally $500,000 a year, you're in the top tax bracket. Your marginal tax rate, which is actually conservative if you're a California investor, your marginal tax rate is 40%. You're able to deduct $150,000 off your tax return, which is going into this private family foundation of which you have control over. $150,000 times 40%, what is that? $60,000 of tax savings, right? So you just pocketed $60,000 in your personal pocket by taking $150,000 and putting it into this charitable entity. Now, not only is it tax savings, but how else does it benefit you? We're going to get into that. Before we get into that, I want to explain that there's one main regulation for a private family foundation, and that is that you must distribute at least 5% of net investable assets per year. So if you put $150,000 into the private foundation, now you have to distribute at least $7,500 this year. So what can you distribute the money towards? Well, it's kind of a sliding scale where you can be a flow through to other charities. That's the bottom point right here, grants to other charities. If you want to send that money directly to the Red Cross or, Make-A-Wish, whatever your favorite charity is, directly out of your foundation, of course that meets the minimum distribution requirement. You can, of course, fund your trips out to these, third world countries where you're building wells and schools and, giving all that money directly away. On the other side of the scale, you can use the distribution requirement for many beneficial expenses, which help you out personally with your personal wealth. So what's an example of that? Well, what about life insurance? What if you as a director wanted some life insurance on yourself, and so you used that 5% minimum asset distribution requirement on purchasing life insurance for yourself, right? Life insurance grows tax-free, right? Here's a billionaire tax strategy. You have this life insurance, you use it to take loans against it, right? That's why billionaires get life insurance, not just for the death benefit, but for the growth that it can have tax-free at a higher percentage rate than cash, right? And safer than potentially stocks. It's not going to crash, right? When you do like one of those index universal life policies where it's growing minimum 3%, maximum 10%, right? So it's not going to go below 3%. What money market account can you get at least 3% on? You really can't. So they put their money in there, they park it as a substitute for cash, and then they're able to grow tax-free. They take a loan against it, and maybe their business, right, takes that loan against it. So now when that business pays interest, that interest expense now is deductible to the business. But the growth of the insurance is tax-free. So that's not what this strategy is about, but I'm telling you that these high-level tax strategies go very, very deep, right? This is something that you're not going to find on the first page of Google. You can also meet the distribution requirement through foundation retreats. So what does that mean? That means when you're going to Fiji with your family, you're going to go there and you're going to discuss retreat business. You're going to have a board meeting. We're going to talk more about board meetings here in a little bit, but you're having a foundation retreat where maybe you're going to, one of these great places to vacation that might also be of the lower economic rung countries, where you're looking at different places that you could allocate some of your charitable funds, right? Are you there for a week? Are you having fun? Are you hanging out with your family, getting closer, getting some serious personal enjoyment out of this expense? Of course, absolutely. That's the magic of tax planning, is lifestyle maximizing, tax minimizing. That's the reason why we're entrepreneurs. It's the reason why we work so hard to make this money, so that we can really enjoy it. And saving taxes while you do this is going to help you enjoy your life enjoy your funds, that much more. So you can go on foundation retreats and go to Tahiti and go explore areas that you're thinking about allocating charitable funds, or you're going and having these board meetings with you and your family and you're discussing your charitable intent throughout the year. That absolutely fits in that charitable distribution requirement of which you got to spend $7,500 throughout the year. Maybe you do your foundation retreats. Maybe you pay, some employee to help you out with administration, right? That's going to meet the distribution requirement as well. So there's many different ways you can spend the money that's going to both benefit the charitable purpose and benefit your personal life. The last thing is for you business owners. Here is a huge piece of game. This is not even tax savings. This is just general wealth generation. Private family foundations and all 501c3 nonprofit organizations qualify for ad grants. Think about the 4 main social media platforms, and you can Google this right now. In fact, Google is one of the platforms that gives you up to $10,000 a month in free nonprofit advertising. Same with YouTube, Facebook, Instagram. These 4 platforms will give you up to $10,000 a month. It might be a match for what you have to contribute, what they will contribute, but they will give you up to $10,000 a month each. That's up to $40,000 a month from each platform, or from cumulatively for all the platforms, in free advertising. Now you can have a joint venture between your for-profit business and your nonprofit business. And of course, the ad has to have some banner that states 30% of my profits are going to this charitable cause, to this foundation. And that's enough to justify the advertisement for your joint venture, which of course is growing your for-profit business, but is also growing your nonprofit business, which is therefore benefiting the world, right? So that is a massive piece of leverage that you can use. So not only are you saving taxes with this organization, you are making more money for your for-profit business with this organization. Maybe you also like to put on events, right? Maybe you want to get people together for this good cause and even solicit donations to further benefit your cause and your foundation. You can do that as well. So private family foundations, if you operate them properly, can be a massive tool for leverage for your business, for your taxes, for your personal wealth as well. So that's why the billionaires use these. I'm going to basically skip through this next one, right? Charitable LLC strategy. This is something that I'm going to suggest you make at least $1 million, maybe $500,000 plus. But here's the entire concept: is you donate maybe an appreciated asset, or you have significant income coming in, you put that money into a charitable LLC of which you own 100% of it, right? You're going to donate 99% of that LLC. The way that the operating agreement is set up is that 99% that you're going to donate is non-voting units. So they do not have any voting rights. They don't have any management control over this entity. So you're going to pledge those non-voting units to a charity and get a deduction for 99% of whatever you donated into the LLC, whether that's stock, whether it's cash, whatever it may be. So now all of a sudden this charitable LLC has all this capital in its hands. What's it going to do? Well, here's how you can utilize it for massive tax savings and personal wealth benefit, while also serving a charity, of course. You're going to then loan money from this charitable LLC to the investment LLC, right? Investment LLC is then able to invest the funds, right, and get a significant return, far beyond what the AFR IRS rates are. It's currently like 3.25%. It might go up a little bit because interest rates are going up, but the minimum payback from the investment LLC to the charitable LLC is about that AFR rate, of which a little bit is going to go to a charity, the charity that you donated the 99% of the stock to, right? So they get paid a little bit, but you got this massive tax deduction. And then any surplus from the investment LLC is going to go to another trust, which is a beneficiary defective inheritance trust. That is going to pay the HEMS expenses for you, for yourself, the individual. So you get massive tax savings, right? You still get the return on the funds that you invested for the tax savings. You pay a little bit to the charity every year. So of course, there is a altruistic purpose being served, but the net that you take home after implementing a strategy like this, let's say you have $1 million of income, you're going to net about $75,000 a year, every year that you do this. So I'm not going to go too much deeper because that requires an entire legal and accounting team, of which I serve on teams of that sort. Happy to have that conversation. Had a quick question. And so the owner has the ability to invest in whatever they want. Absolutely. With the investment LLC, you are the manager. You have complete control. You have complete discretion to invest the assets however you want. So these are some very powerful strategies when it comes to charities. I think very few CPAs and accountants consider what the tax benefits are for charitable LLCs, what the tax benefits are for using charitable strategies. And you do have to be careful. You know, you don't want to completely frivolously just manipulate the rules at all, but there are significant cases, right, and rules that you can follow to still unlock significant leverage. So it does take a good, proactive CPA. So let's get out of charitable strategies and let's get into ones that are even more immediately applicable for your business. So of course, let's get into depreciation strategies. I bet if you're on TikTok, if you're on social media, that's where most of everyone has found me. If you're into TikTok and tax strategies, you've probably heard of writing off your G-Wagon, right? Why is that? Because it weighs over 6,000 pounds of gross vehicle weight rating, right? Which the IRS then deems as a cargo vehicle and says you can depreciate 100% of that asset if it's used over 50% for business, regardless of the purchase price. If it's under 6,000 pounds, it's only 18,200. I want to say that's the amount for 2021. And these numbers are always increasing or decreasing by a little bit. But buying vehicles, maybe you buy equipment. If you need to make some significant purchase for your business, you can purchase it before the end of the year and take that Section 179 in bonus depreciation to get a significant benefit in the current year. Understand that depreciation is about the time value of money. So money now is worth more than money later. If I can accelerate a deduction and receive $10,000 now, how much is that worth 1 year from now? Wouldn't it be worth maybe $11,000 if I can get a 10% return, right? So that's a time value of money. It's a basic finance concept where if you can get a return, especially in businesses, if you have a successful business, if you could unlock $10,000 for your business right now, could you invest that and turn that into $20,000 of gross revenue, $15,000 of net profit, right? If you can get yourself this tax benefit now by accelerating the depreciation, then you can have that much more money a year from now. So that's the benefit of accelerating depreciation. The downside is this point here, right on the bottom left. More depreciation now means there's less depreciation later. So there are some strategies to mitigate that fact, but based on the time value of money, you would rather have more depreciation now because it's worth less later. Now, of course, that does depend on future tax rates. It does depend on your future projections, but in general, if you're gonna get the same deduction, the same tax savings now, or a year from now, or 2 years from now, you're gonna want it right now. So you can purchase assets that are directly implementable for your business, or for example, you could purchase other business assets. I have all kinds of clients that are making maybe millions of dollars on a W-2, and they come to me and they ask, well, what can I do to save taxes on this significant W-2 or this significant significant business income? I don't have any assets that I need to purchase. Or in the case of the W-2, they don't get to take deductions against their W-2 business income, W-2 employment income. So something that is applicable for both W-2s and business owners is buying other business assets, right? But of course, if you're making a multi-million-dollar W-2, you probably don't have much time for anything else. So what is something you could purchase that gives you business depreciation, but you don't have to put, your entire life work into it? The most powerful example that's super popular, especially the last couple of years, is short-term rental properties, Airbnbs. That's why they're so popular these days. That's why there's so many popping up these days. It's because you can buy a property that you plan to Airbnb out, and if the average length of stay is 7 days or less, then it's a active activity. And so I should compare that active activity to what they call passive activities, right? Where if you have the average length of stay over 7 days, unfortunately, you cannot write it off against your active income. It's a passive activity. Passive activities can only go off to offset other passive activities. Passive losses cannot offset active income. But when you have a short-term rental, 7 days or less, you have an active activity, which means losses from this Airbnb can offset your W-2 income, can offset your active business income. These are really, really powerful strategies. If you have $1 million W-2 income and you purchase the Airbnb, right, for $1 million, and you cost segregation study it, so now you have $700,000 of depreciation, again, at a 40% marginal tax rate, you just saved yourself $280,000 in taxes. Does that not go, does that not cover the down payment right there, just with your tax savings? So this short-term rental strategy is extremely powerful. A couple other strategies that I'm looking to implement for my clients is maybe Turo vehicles is an example, or crypto miners, right? If you're into cryptocurrency and you believe that long-term Bitcoin's going to win or Cardano is going to win, right? You can purchase a miner. You can even have it hosted in some facility, so you don't have to put any time into it whatsoever. But because you purchase the crypto miners, it constitutes a trader business generally, and you can depreciate through bonus depreciation the entire purchase price of these crypto miners, right? So imagine you have a $500,000 business and you buy $200,000 worth of crypto miners. All of a sudden, you just saved $200,000 off of your taxable income, $80,000 of tax savings. Over a year, crypto miner is going to pay itself off, right? So whatever you just spent, you're going to get your money back, and you're making passive income every month, every day, every year. Crypto miners are a big one, especially for those that are in crypto, believe in crypto long-term, a high-income business owner that doesn't want to put any more time into anything else, but they want immediate tax savings because they believe in the time value of money. Buy a crypto miner, buy 10 crypto miners, have it hosted. It's cheap to have them hosted, or they're going to help you source power. All you're going to do is pay for the hosting and maybe some electricity. You still get a significant bonus depreciation, and you can write it off in the first year. Business purchases is another one. I have clients that purchase businesses, right? So when you purchase a business, you need to structure it as a purchase of assets, not a purchase of equity. Now, there may be a little bit of pushback from the seller, and the reason is this. Oftentimes, there is a higher tax liability for the seller when it's structured as a asset sale if all the assets have already been depreciated. But there is significantly more benefit from the buyer to structure it as a purchase of assets. And this is why. When you purchase these assets, you get to reestablish them on the balance sheet. So if you have to buy a capital intensive business that has like vehicles, or they have a dump truck, right, and it's been depreciated to zero on the other businesses, the business that's being sold on their balance sheet, and you purchase the equity of the business, you still don't get the depreciation benefit. But if you purchase that as a sale of assets, you get to reestablish that dump truck on the balance sheet and write it off for tax purposes, right? So essentially your purchase price of this purchase of assets now becomes deductible, and you can absolutely do bonus depreciation on this dump truck. And that first year of purchasing this new business is saving you significant sums of money. So for my serial entrepreneurs out there, and you're looking into buying a business, understand you need to work with a good accountant or CPA to evaluate what your tax options are when purchasing the business. Because if you do it as a purchase of equity, it may lead to a greater tax consequence and less tax saving opportunities than if you structure it as a purchase of assets. And so this last point is about itemizing the asset to selectively delegate bonus depreciation. If you buy 10 miners and you only want to take the bonus depreciation on 5, then you need to set up each miner as its individual line item on the depreciation schedule on your taxes, which you can do both. You can either itemize or you can bunch them all into one. But if you bunch them all into one, you have to choose one depreciation method. If you itemize these miners, you could choose the depreciation method per each itemized asset. So make sure that you itemize them, because you can do the same thing get the same amount of depreciation if you don't itemize, you bunch, but you can't get the same amount of depreciation. You don't have the same options if you bunch compared to itemizing the assets. So depreciation strategies are absolutely a great consideration for high income earners, entrepreneurs. Had a couple of questions come in. Does it matter if purchasing new versus used assets for this depreciation strategy to work? I'm not going to say conclusively. I want to say it's either. If you can't do bonus on newly purchased assets, you can use Section 179 assets. So you can purchase used assets and depreciate them 100% in most situations. Can you defer the depreciation after the first year, or purchase if you do not have enough income that year for it to make sense? Yes, you can choose bonus depreciation in later years. You can just depreciate straight line or macros depreciation in the first year if you don't make enough income. Or you choose bonus depreciation in the first year, and any net operating losses are going to be carried forward. So that's another benefit as well. I have clients that purchase a dump truck, depreciate it, and now boom, they have an $80,000 net loss. It's not like they lose that loss. It's called the net operating loss that gets carried forward into future years. Awesome. Keep dropping the questions in the chat. We're on to our third and final strategy, which is optimizing your eligible business deductions. And I said I'm not going to discuss the home office deduction. So we're going to skip that. Of course, take the home office deduction. We're not going to talk about automobile deduction. Hey, track your miles or depreciate your vehicle. We discussed depreciation in the previous slide. I'm not going to go over the Google searchable ones. You can find 280A on TikTok for sure. But I just want to say it is viable if you rent out your home to your business and you have a legitimate business purpose. If you want to bring people over and have a board meeting, which we're going to talk about in the next slide, then you can absolutely do so. Have a company retreat or a content shoot day. Take a picture of the kitchen that you rented out to yourself. Find a reasonable fair market value by using a comp on Airbnb or some website, and do it for less than 14 days a year. Do it once a month, and then 2 months, do it twice in that month. Augusta rule is absolutely a deduction you could take if you do it properly. Some CPAs will say you can't take it at all. Some CPAs will be overly frivolous with the deduction. I say if you have real business purpose and you take meeting notes, you can absolutely do it. Just keep good, record keeping and documentation. Maximizing your travel and meals. That's pretty self-explanatory. If you are going out to a restaurant, try to bring a business associate, right? Have a business purpose. You can't be frivolous and you can't, BS your meals expenses and your travel expenses. But if you have a documentable business purpose, if you have the receipts to prove that you took out your business partner, your wife, your girlfriend, one of your best friends, right? You don't do it, 5 times a week. You can absolutely write off those meals. You can absolutely write off your travel, where we talked about with the foundations. You can do, foundation retreats. Well, you can actually also have board meetings with your business. Again, don't be overly frivolous, but if you want to go to Hawaii and take 3 days and have a board meeting, take notes, make lanyards, take a picture of the lanyards. That's great record keeping. That's great documentation. It would be hard for the IRS to dispute that. They'd have to really, really not like you for some reason in order to offset that deduction. Because if you have good record keeping and good documentation, then you can write off everything with a business purpose. So let's continue. I'm going to start first with the board strategy because we've spoke about that a couple times. Add your family and friends to your board. Now, when you're going out on meals, they're deductible. Of course, discuss business. Maybe take some notes. This is what specifically you talked about. The IRS is going to want to see that receipt. All right, did you pay for 2 people's worth of, items, or did you only pay for 1 person's worth of items? Oh, it was 2. Oh, this is what you talked about. Oh, this is who you're out with. Can't dispute that, right? You have the receipt right there. That's how you would do that. Now when you go on a company board meeting, just like your, private family foundation retreat, you can write off when you have the notes and the documentation. How about hiring your kids? I love this strategy. If your kids are under 18 and you're a sole proprietor or Schedule C, You don't have to issue them W-2. You don't have to pay the SUTA, FUTA, FICA taxes. You don't have to do anything other than put the money from your bank account into their bank account. You get to deduct the wages when it's under $12,000, $12,950 for 2022. You can write off, or you pay zero income taxes. Your child pays zero income taxes on the wages that they received. Do you get the deduction for paying those wages? Absolutely. It's a business expense. Now, of course, you have to do the actual services. You should document, but you don't even have to file a W-2. You don't have to do any tax withholdings whatsoever. Imagine getting a $6,000 deduction by paying your kid $500 a month for the few things that they do in your business, and then using that $6,000 to do one of two things. Number one, pay for the expenses. You're already paying for them anyway, right? You just unlocked a couple $1,000 worth of tax savings by doing this. Or contribute to a Roth IRA. When your child has earned income, they can contribute that earned income up to $6,000 a year, hopefully soon $7,000. And when they turn 60, 59 and a half, they can start taking these distributions completely tax-free. The growth is tax-free. The distributions are completely tax-free. So deduct their wages, pay zero taxes on the income, and then when they turn 60, I mean, imagine 50 years worth of compounding. You do this for 5 straight years. I mean, how much money would they have to then distribute to pay for their retirement? Teach them a little something about delayed gratification. Teach them about operating a business. Of course, you want them to actually do the activities in the business. So maybe they'll learn about entrepreneurship as well. Hiring your kids is an extraordinarily beneficial strategy for tax savings and for life lessons. I love hiring your kids strategy. Similar to the board strategy and similar to hiring your kids, a family management company. If you're extremely wealthy, having your kids intimately involved in your finances and compensating them for that is like a combination of the board strategy and hiring your kids. So that's another one that extremely wealthy families will implement. Set up a family management company, pay your kids, do the hiring your kids strategies. It just unlocks all kinds of other deductions, right? That wouldn't otherwise be deductible by setting up a company that specifically manages your wealth. I mean, that's what a family office is, right? And you can hire your kids in your family office. Nepotism is not illegal. Well, in some cases it is, but in tax law, nepotism is not illegal. Maybe you don't do it in, I don't know, government, whatever. You can do it in your personal business, right? And you can get significant tax savings. Okay, so that is optimizing your eligible business deductions. Just be intentional. Understand that if you have an ordinary and necessary reason for paying for something, you can write it off. That's the IRS definition of an eligible deduction. Okay, even if it's not travel or meals, maybe if it's office expenses, right off your computer, right off your telephone, right off the things that you use for business. Okay, so that is how you optimize your eligible business deductions. Here's a quick bonus for you. The ultra high net worth structure their entities in such a way that are far more beneficial than S corporations. With certain trusts, I've seen the ability to defer all passive income through complex trusts. That's capital gains, that's rental income, interest, dividends, could be royalties. That will significantly reduce your taxes. You could even potentially mitigate some of your active business income taxes through ultra high net worth entity structuring. It's not the exact purpose. So I'm not marketing to ultra high net worth right now. We're discussing 6-figure plus entrepreneurs, how you can save taxes. When you're in that middle 6-figure range, right, 200K plus, it's worth having that discussion. If you have a significantly high estate, millions of dollars, or in Washington, it's like $1 million estate tax exclusion is low. That's when it's necessary to engage with a CPA that has significant experience in entity structuring for the high net worth, the ultra high net worth. So I wanted to discuss quickly as a bonus how the higher levels of income defer and mitigate their taxes and even protect their assets. It's through proper estate planning. You need to be thinking about this if you're making a couple $100,000 plus a year, especially if you're making millions or have a estate of 10 million plus. So if you want to talk about ultra high net worth entity structuring on the tax planning call, we certainly can do so. Pretty good at sniffing out that need when we get onto the conversation and learn a little bit more about your background. So that's your bonus. Hopefully you enjoyed that. Those are the three main strategies. Here's just a little bit of my experiences, testimonials, some people I work with. I work with a ton of crypto investors. I work with a ton of, entrepreneurs. Madison, she's awesome. She's a family friend, actually. She's a personal trainer, makes a lot of money, helped her save significant sums in taxes through tax planning, right? Featured on Coffee and Crypto because I'm consistently helping crypto investors save their taxes, crypto entrepreneurs too. We discussed the crypto mining. That's a big one. So if you're a crypto investor, it can help you discuss tax mitigation, wash sales, all the above. So those are some of the people I've worked with. Here's one of my favorite things to do, which is implement tax saving strategies. So here's just a couple more examples of clients I've worked with. Names have changed for the purposes of this public recording. We've got Julie, who's a real estate agent, no tax planning whatsoever. We implemented a couple different entities as Corp, hiring a kid, doing the board meetings with their family, implementing an HSA, and we saved $18,000 in tax savings. That's per year. Dylan, he has an HVAC company with no tax planning at all. Implemented the S Corp, we did a retirement account, solo K, the Augusta rule, self-employed health insurance, HSA. Of course, we implemented, travel and meals deductions. I didn't include those because he's going to have those anyway, but it's basic, education on, hey man, structure your life in a way that's going to increase that number, not frivolously, but reasonably with the receipts. They really benefited. I mean, $18,000, $13,000 in tax savings, $20,000 for this client right here. He didn't have any strategies available for the rental property because he didn't have a rental property, right? But for people with rental properties, there are significant tax saving strategies, right? That board meeting strategy, you can do that with your rental real estate, family management company, right? You can do that with your rental real estate. You basically start your own family property management company, save significant taxes through utilizing that strategy. Didn't apply to this client, still comes up, when we do the Corvey tax planning, but this client specifically saved about $20,000 on their taxes. Now, higher income individuals, implementing trusts, private foundations, right? And utilizing every single one of these can save in the six figures. I've absolutely seen in the six figures. I've seen the seven figures of tax savings. The average entrepreneur that's implementing these strategies might not be ready for the multi-millionaire tax strategies. You can still unlock $13,000, $18,000, $20,000, $40,000 of tax savings by implementing these strategies. It's exactly what I do tax planning. I only work with people that I can make more money than they pay me. It's a hell of an offer. It's a good offer. So that's the summary. Strategy of charitable deductions, strategy of depreciation strategies, optimizing your eligible business deductions, more than just, oh yeah, maybe I should include a little bit there, retroactively taking a look, and seeing if I had any meals, being intentional. I'm going to do a monthly board meeting where I'm going to write off my meals, right? I'm going to rent out my house to myself, and I'm going to save $5,000 a year through this intentional tax planning. That is the benefit of proactively engaging with the CPA. So there's hundreds of strategies, truly hundreds of strategies. That's exactly why I have a tax planning software. So I don't have to forget anything because I leverage technology to remind me of every single available tax strategy. And I go through intentionally and choose the ones that fit your situation based on whether you own a home, whether you have kids, how many businesses and entities you have, do you have partners, do you have a rental property. There are many input data points that lead to hundreds of possible outputs and tax planning strategies. So that is what I do. That's what I'm offering, is really just a free tax planning conversation to discuss your situation, to discuss how you could save taxes specifically for your situation, right? So if you can't save at least 3 times more than your investment, unfortunately, not going to be a great fit. That's how confident I am in the strategies, because I've done this multiple and many times, and every time we're able to get significant tax saving. Now, if you call me and you're a W-2 employee, you don't have a business, you don't have a rental property, unfortunately, probably not going to be able to get you significant tax savings unless you want to do one of those charitable strategies. But I work with entrepreneurs. I'm an entrepreneur myself, and I can save you significant amounts of taxes through education, implementation, and accountability. So now is the chance to sign up for a free 20-minute tax planning call. We're going to get into your background. It's like a doctor's appointment, all right, where we're going to go over your symptoms. We're going to go over your background, your history, right? And we're going to discuss what potential opportunities there are in the future. And if it's a good fit, I can tell within 5 to 10 minutes whether there's opportunities to save you taxes or not. In that 20 minutes, we'll go over some of the general strategies. We'll get a lot of your background information, and then we're going to come up with a prescription of great ways to save you on taxes in future calls. So there's my calendar link. It's also in the QR code right there. When you go on my page, you'll see that we're basically booked until mid-November. We're at that real estate event. Absolutely booked this up because everybody wants to go over tax planning, especially before the end of the year. So I can only commit to doing tax plans for 5 people, because once December comes around, we're getting ready for tax season 2022. It gets really busy January through April. It keeps us busy in December preparing. So about that mid-November to early December range is our window of opportunity for me to help you save 20 to 40K or more in taxes. So please book now. Only going to work with you if I can get you a significant ROI on tax planning. And if not, then there's still plenty of information I'm happy to give you. And you'll always have access to this recording, this webinar. Feel free to follow my socials, Anthony Price CPA. I'm on TikTok, barely. I'm on Twitter, my biggest platform. I'm on Instagram, Tax Tone CPA. It's my Instagram. Thank you so much for being here, watching. It's about 45 minutes. If you guys have any questions, happy to go into questions. Thank you guys so much for the support. But we've definitely got some time if y'all have any questions. If not, then enjoy the next 12 minutes before all your 12 o'clock meetings for lunch. You gotta get some good tips out of it. That's certainly not Googleable information, right? Hiring your kids, do it. Absolutely hire your kids. I mean, it's such an effective strategy to hire your kids. Like, you know, even if they're sweeping the floors, licking envelopes, whatever, pay them a couple $100 a month. I mean, you already pay for their expenses anyway, right? You know, you're already paying for however many dollars of expenses anyway. So if you can write that off because of the fact they're hanging out with you while you're at the office, right? And then you pay for those expenses with the joint bank account that you pay him in, then you just get to write off the expenses that you're paying for anyway, because he's doing the things he's going to do for you for no pay anyway. So yes, that's a good point, Pierre. They're old enough. You can hire them pretty young. I mean, they can perform little duties, right? They could be your model for your social media. You know, they're certainly not going to command an extremely high premium. 6 and 8, that's definitely pretty young there, but they can do a few, you know, they can sweep a little bit. They could be your social media content, you know, models. They can't make, you know, thousands and thousands a month, you know, but they could make a little bit of money even pretty young. You know, this isn't the same labor laws where you can't start working until you're 14, because they're your children. They're your children. That's why you don't have to file a W-2, right? Because they assume, all right, they're your kids and they're under 18. They're not going to sue you for unemployment. They're not going to sue you for workers' compensation. You're responsible for them anyway. Therefore, they don't require a W-2. So that's the reason why. Yeah, that's certainly one of my favorite strategies as well. I see it is for you guys too. So thank you very much for attending the webinar. Certainly hope to speak with you all individually. I'm available. Give me an email, give me a call, sign up on my calendar. I think that's all the questions we have for now. So we saved a little bit of time. Hopefully it was direct and to the point. If you guys have anything else, feel free to shoot me a DM, shoot me an email. Thank you guys. Appreciate you attending. Take care.